why do they want to give money to people like Blackstone and not the commercial banks?
Well, because a few years ago when First Republic, New York Community Bank, and other banks were starting to have runs on the bank and defaulting, the Fed realized that direct commercial lending can be quite risky. And so when that financial crisis happened a couple of years ago, the Fed decided to change the reserve requirement to motivate the banks not to make the direct mortgage, but provide the back financing to the Blackstone. So that way the debt fund is at risk for that last level of financing and not the depositor's savings money.
Good afternoon, everybody. Welcome back to Confronting the Impossible. My name is Leo Jacobs. I'll be your host. And this is where we discuss the trials and tribulations of the people that are in distressed real estate and of the actors in distressed real estate. I have a very special guest with me today. I'm very proud to have him along. He's a good colleague and part of the distressed industry, Rob Deckey of Multi-Credit Partners. And he's been in the distressed industry for probably 30 plus years. And I'm very proud to have him here. Welcome, Rob. How are you today?
Awesome. Thank you.
Excellent. Excellent to have you. Thank you very much for coming over to our Fifth Avenue office. It's very nice to have you. Please, for the people that do not know and are listening, tell us a little bit about yourself, an elevator pitch, if you will. Please.
Sure. Thank you, Leo, for having me here.
My pleasure.
So by way of background, I graduated from business school in the middle of the S&L financial crisis. Thinking that was a terrible time, I actually got the best lessons of my life on distress investing and how real estate values can go up and down very quickly. So I worked for a dozen years in investment banking at JP Morgan and Citibank, doing REIT IPOs. And at the time, these IPOs happened because whether it was the Tauman Company or parts of Trammell Crow Residential, they were suffering under lots of debt. And so the REIT market opened up to provide the equity to pay off those debt and give these developers a second life. So I worked on the IPO Prologis and many of the good REITs today that exist. So having seen how those developers had to reimagine themselves from being private company, over-levered, high-recourse borrowers to becoming public company CEOs, and how they had to morph their companies many times from regional players to national players and grow through M&A to become multi-billion-dollar companies, was very fascinating in my formative years of my career as the dozen years I spent in REIT banking. And then in 2001, when we had the dot-com bust, a company that I had filed an IPO for on the tails of SL Green, George Comfort and Sons, stayed private. And so I joined them and worked there for 13 years, doing mostly distress office investing, using really the skills I had built on earlier in my career. And then in 2015, I saw the end of the lack of the future of the office world, decided I needed a new career, and joined Invesco, where I was until recently for almost a decade, running the New York office and East Region. And they're really diversified into many other property types as just a good investor. And then in the last year, I was looking for where there is further dislocation and have really identified multifamily refinancings coming up, having the second highest default rate after office in the mortgage sector as an opportunity to provide a solution to the impossible. So that's a snapshot of my career.
Excellent introduction. I actually want to start from the very first thing that you did, which was taking private CEOs and
taking public
taking them public. Am I
Yes,
correct? So they were
yes.
private CEO.
They were private companies, and they saw the public market, public equity is cheaper than the bankruptcy they were facing by many of their lenders. So the way to pay off those loans, pay down their debt, and reform their companies as public REITs.
And when they did that, what must they have done in order to get out from under? What did those CEOs have to do?
Well, they had to.
Because they were confronting their own impossible.
Correct. The number of banks that were going out of business and the RTC. And that brings me to the evolution of distress investing. So in the early 90s, when the government took a bank over, they would just flash sell the loans, distressed loans, to the highest bidder, which was at the time just this small company called Blackstone, Morgan Stanley, Whitehall, and so there are just very few distressed debt real estate buyers. And the government was very inexperienced, and they just sold these loans for pennies on the dollar. And Blackstone, those are the golden days of distressed real estate debt, buying from the RTC, those pools, and people are making 30, 50% IRRs. With every cycle and decade since the 90s, both the government and the banks have become more sophisticated. So more recently, when the government was selling New York Community, First Republic's distressed loan book, they learned, and so they sold the majority of the book, I believe, to Blackstone. But the government said, we're going to keep 90% of the recovery and profits, and you, Blackstone, get 10% in an asset management fee. And so there's less distress today than there was 30 years ago, because less distress available for sale, because many of our lenders, commercial banks, insurance companies, CMBS trusts, special servicers, realize that by doing blend and extend and not flash selling loans at the bottom of the market, you can have a much higher recovery. So
recovery for
the original principal balance.
Not only the interest.
Not only the interest, but also principal recovery.
So now that stresses the current lender.
So a lot of lenders today, including the federal government, if they take back loans, will work with borrowers to do pretend and extend. So you're not selling in the moment of where the market is at the trough, but if you can work out a solution and sell it in a year or two, you'll have much better recovery than at the moment of the crash.
So, Rob, I want to challenge you here.
Yes.
Because we're not in the 90s. We're in 2026.
Right.
And the private market is not allowing some of the clients that I represent or some of the restructuring firms represent to breathe. They are acting as the fiduciaries for their investors. A prominent example is Charles Cohen. Charles Cohen is being foreclosed on, as you know. Just today, he lost his prized possession, which was 750 Lexington, to his lender, to pay the lender back on his personal guarantee of $185 million. That's nothing to sneeze at. And there was no pretend and extend there. There was a vicious attack an aggressive attack by Fortress on his assets, and that spoke to, I guess, a change course in the way the 90s had been fashioned, where they weren't sophisticated and not in the way that people were pretending and extending about 2 years ago. Right now, people are taking their assets for the betterment of their investors. So my challenge here is there a road here today that it's still going to be blend and extend, pretend and extend? Because I'm seeing something very, very different. What's your opinion on that?
Well, I think in the special situation of Charles Cohen, correct me if I'm wrong, Fortress had provided him a very highly leveraged, personally guaranteed loan. So they are not the most friendly of all
Well,
lenders.
then you have Maverick.
And Maverick. So these are guys that are making highly leveraged loans with a lot of personal recourse. And so that's why they can go in and be the tough guy and force the sale of these assets. However, I think if you look at more insurance company, traditional senior commercial bank loans, or even CMBS trusts, they are frequently, because you have a senior lien, especially in New York, it could take 2 years to go through the courts to foreclose. People will work with the borrowers to, they understand, for example, office, you have a high vacancy and income is down. It's hard to refinance today. But even in the case of office, 2 years ago, it was impossible to get an office loan. Today, the SASB CMBS market and even the bank market for certain office buildings has reopened. And you've seen a recovery over the last 2 years in the office lending market. Obviously, it's not where it was pre-COVID, but it is much better than it was 2 years ago. So I think in general, senior lenders, the ones I mentioned, will work with their borrowers, if the borrowers are doing the right thing, to figure out a solution to recover some of the principal and interest loss and not do a flash sale or take over the asset. I think in the situation of Charles Cohen, that was a very highly leveraged personal guarantee loan across his portfolio, and that was a very different situation.
It was an exception to the rule, you're saying.
More on the fringe of, aggressive lenders than a more traditional senior lender.
So I'll challenge you one more time about what you're doing, but maybe before I do that, why don't you tell us, now let's fast forward from 90s to now quickly.
Yes.
What are you doing now that is confronting another impossibility?
Correct. So historically, as a distressed investor, I would love to go buy distressed loans and distressed buildings. However, because the lenders and the Federal Reserve are more sophisticated, there isn't the large amount of distressed loans for sale at discounts in the marketplace.
Interesting. I didn't know that.
And because of that situation, but you still have the second highest default rate in multifamily, we see a situation where in the next 3 years, 180 billion of multifamily loans are expiring, over 80% loan to value. Because many of these borrowers, when interest rates were low in 2020 and 21, were borrowing at 3.5%. The new rate on that mortgage today is 5.5% and 6%. 4 years ago, they were borrowing at 65% loan to value. But nationally, apartment values are down 20%. So those loans now are 75 and 80% loan to value. And I think that has been well publicized in the Wall Street Journal. Apartment performance and rents have been very soft due to some of the overbuilding. So a lot of these borrowers, middle market borrowers, are having a challenging time facing the impossible because, one, the Federal Reserve has told the commercial banks that they have to have 5 times the reserves to originate a senior mortgage versus providing a repo line to a debt fund. So therefore, commercial bank loans to commercial real estate in 2025 hit an 11-year low.
Because the Fed is not allowing.
The Fed is motivating banks to provide repo lines to debt funds rather than originate direct senior mortgages.
What is a repo line for the people that don't know?
For a debt fund, it's providing bank financing, typically around 75% of the loans that you have in your funds. And that's called back leverage, that the commercial banks are providing the Blackstones, TPGs, their mortgage funds.
To do what?
To go make loans directly rather than have the commercial bank use depositor money to make that direct commercial real estate loan.
Why do they want to give money to people like Blackstone and not the commercial banks?
Well, because a few years ago when First Republic, New York Community Bank, and other banks were starting to have runs on the bank and defaulting, the Fed realized that direct commercial lending can be quite risky. And so when that financial crisis happened a couple of years ago, the Fed decided to change the reserve requirement to motivate the banks not to make the direct mortgage, but provide the back financing to the Blackstone, so that way the debt fund is at risk for that last level of financing and not the depositors' savings money.
Effectively, the depositors being the citizens of the United States.
Correct.
So
it made the banking system more stable. This created this void in the marketplace where now over the next 3 years, we have $180 billion in multifamily loans expiring over 80% loan to value. You have the traditional lender to those developers, the banks pulling back. And so this is creating this void in the marketplace of all these refinancings. And so they're all being extended, giving the developers more time to finish leasing up their building and executing their business plan. So multi-credit partners sees an opportunity to come in and provide senior bridge loans to these multifamily borrowers, 65 to 80% loan to value at reasonable spreads, SOFR plus 300 to 400, to help them refinance the loans that they have coming due and expiring.
And you believe that there will be no extending and pretending?
No, I do think there's a lot of extending and pretending happening, but those lenders want to get paid off. And so we're providing the refinancing capital so the developers can pay off their pretend and extended loan. And we are giving them a new 3 to 5 year bridge loan to help them finish to execute their business plan.
You're helping the financed borrower refinance.
Correct.
To flush out old lenders so they can go and do other activities.
Correct.
And
or more importantly, stabilize their existing asset, finish the leasing, finish any renovations they were doing, move the NOI up, so that way they can then take us out with more traditional agency financing.
Well, what's the SWOT analysis on that? Is it borrower heavy and how you would underwrite that, or is it asset heavy? What are you underwriting? Which is a very important question.
Totally.
Because your firm, if I may call it
Correct.
Multi, is taking the thesis that irrespective of whether you invest into the borrower or irrespective of whether you invest into the asset or irrespective of whether you invest into both, the value of the property must go up. I beg to differ, and I do, Rob, because in confronting that impossible of the refinance market, which you want to delve into, that impossibility doesn't go away with your refinance. I wonder what your thoughts are about how you as a lender now, or a broker or both, are going to navigate that impossibility.
Sure. So
which is a challenge in and of itself.
Exactly. So the benefit of having been through 4 cycles is that no one can ever predict the bottom of a market.
Correct.
However, there are telltale signs of when you're potentially at the bottom.
Tell us.
And when it's time to jump in. So having been through the 90s, the dot-com bust, the GFC, in COVID, the fact is apartment values are down now 20%. Interest rates are at kind of a stable level of where they've been on average for 30 years. And we have a housing crisis and people need a place to live. And so a lot of markets are starting, apartment development is approaching a new low because people can't afford, as it was quoted in the Wall Street Journal today, between expensive construction financing, inflation and tariffs, and my construction costs. It's very hard to build a new apartment building today. So new supply is significantly down. Absorption is happening in most of these markets. And so once occupancy hits 92%, we should see in most of these markets rents to start going up. And those are we're hitting right now the bottom of multifamily. Values down 20%. This is the best time to jump into a market when you're rounding off the bottom and new supply pipeline has been turned off. There should be rent growth coming, housing crisis, high demand for housing. So those are all telltale signs that we're at the bottom of the multifamily market. And that's when I want to come in and be lending at 65 to 80% loan to value at the bottom. So when values go up and the markets recover, that my assets should be appreciating. The worst time to lend is to come in at the top of the market. So at the start of COVID, when cap rates were 3.5% and every developer was building, that's the last time you wanted to go make a 3.5% interest rate loan. Now's a great time. Debt is more expensive and values are down. So buy low, sell high.
And I appreciate that, Rob. What I'm saying is, and it's not to drag the thesis down. It's to stress test it.
Yeah.
And the stress test is going to be not that that's only one factor, which you're buying at the bottom of the market or refinancing at the bottom of the market, is now, are you looking at the borrower? Are you
Totally. We start with the borrower. If you have a bad borrower, they will always be a bad borrower. So we start with the borrower, their reputation in the marketplace, their performance. There are good borrowers and bad borrowers. And just like Santa keeps a list of who's naughty and who's nice, my partner and I have a list. So we start with the borrower. Then you're looking at the real estate asset.
Correct.
And its ability to grow income and pay you back your principal. And those are the two critical aspects of being a lender.
Now, isn't the underwriting process a little bit flipped on its head because you don't know who's a bad borrower or a good borrower because the market has put a twist on the borrower itself? You're stress testing the borrower itself as well.
Well, when
the tide
the
lowers,
capital markets, having interest rates go from 3.5% to 6%, that is the capital market. But borrowers we all have long histories. Borrowers' history, we all know, and what happened in the financial market and the change in interest rate. There's still good borrowers because good borrowers will say, okay, well, we're in this situation together. We'll work with you, bank, to work out the problem. How can we work together to find this solution? This was driven by interest rates, not by our performance at the property. We're keeping the property fully leased. It's well managed. We're doing everything possible, but it's the interest rates in the marketplace, right? So I think you got to separate the current financial situation with how the borrower has performed.
I agree with that. That I agree with. So I want to make a parallel to where you first began and what you're doing now.
Yes.
So where you first began is you were analyzing and providing liquidity and taking private actors public, which in and of itself is a refinance.
Correct. It was a capital solution to a financial situation thank you for bringing that up. I never really thought of that. But, it was really at that start of my career that I learned to see into cycles where there is financial stress and where one has to provide a financial solution, and that the markets are always very cyclical. And more recently, that's bifurcated where now property types are cyclical, right? So a year ago, industrial was hot, office was in the shitter. Now office is coming back, industrial's at 11-year high vacancy rates. And so the markets are always cyclical, and one has to be in real estate investing always very agile to pivot from sector to sector, market to market, because nothing stays the same.
So, Rob, you agree with me then that the parallel that I'm creating here
Yes.
is something that fits quite well in what you've done in the past?
Yes, I haven't thought of that before, but you connected the dots.
Good. So here's another observation that I have. You're a bit of on the borrower side, although you're lending or you're brokering on the lender side.
We're lending, yeah.
Yeah, and lending is a very risky business.
Well, I mean, lending is safer than being an equity investor, one.
Maybe.
And two, because we think multifamily values are at a trough, multifamily, unlike office and other retail, other sectors I've invested in, multifamily doesn't have the lumpiness that a big 10-year office lease has, right?
Tell me more about that.
And so multifamily, there's always a housing shortage. So if you drop the rents, your multifamily asset, it should be always fully leased if it's a quality asset. So our view is that if a multifamily loan that we make and the developer has trouble, we'd be glad to take it back because, one, we're only lending at 75% loan to value, 7 return on cost, debt yield, and that's like a 7 cap rate. And cap rates are like 5. So if our developers run into trouble, we'd be glad to take back those multifamily assets because we can lease them up and probably sell them at a much lower cap rate than the debt yield that we're taking it over. So multifamily lending is much safer than office lending. And I know, we've talked about Worldwide Plaza before, but that's an example, office building where every 10, 15 years, the leases roll, the building becomes vacant. It takes a lot of money for TIs and leasing commissions to release the building. You can't refinance when the building's half vacant, and you default on it. And that's happened decade after decade in the office sector, and particularly I know we've discussed in the past, Worldwide Plaza. So very different property types to lend on.
So I want to talk about, now that we've really built the parallel and we discussed a lot about what you do and we've stress tested your thesis a little bit, I want to discuss what it means to be successful in traversing the impossible, specifically in the case of what you have believed to be a good opportunity to invest in. And what you've agreed to invest in, really, in my view, is the borrower's second chance. And I don't know if I want to call it the second chance because I'm having trouble. Maybe you can help me. I'm having trouble identifying or defining what success for a borrower means and what failure for a borrower means. Let's look at it from an objective point of view. Is the borrower a failure in this market today in a multifamily asset because they did something wrong? Barring fraud and malfeasance, of course. But if you're acting on as a borrower on a property today and you've done everything you could and you're still sinking into the ground, what do you have to say to those borrowers that are confronting that impossible or seemingly impossible feat? That's a really huge and psychological construct that I've been examining. My background is in cognitive psychology, by the way. I used to study rats and parrots and cocaine and heroin addictions. So to me, it's important that not only do we examine what your market fit is, but the fitness of the borrower currently, because they might be in default for other reasons other than what we were discussing, which are the external factors. So how do you define how the borrower is either escaping that impossibility or disassociating from it or dealing with it? I'd like to know from your point of view.
Yeah. So let's use two situations, right?
Please.
So one situation is the city of Austin. They did tremendous overbuilding, and now it has an 18% vacancy rate in apartments, right? Those developers, they have their construction loans, and they are having to give massive amounts of free rent out and incentives to lease up their property. So the NOI pro forma that they started with 3 years ago is probably half of what it is today. And it will take Austin quite a few years for the absorption to happen and NOI come back for the developer to be able to refinance their construction loan. Now, I can't blame the developer because the market has an 18% vacancy rate and the NOI is down. And so they have the impossible where they have to refinance their construction loan, and maybe it's at now 80 or 90% loan to value. And so a solution for them will be to probably have to raise a little bit of equity to protect their remaining equity to pay down the loan, and then get a bridge loan to buy them more time to do lease up and have NOI recover, so they can then get a new loan for a more reasonable 65% loan to value.
That's the first situation.
First situation.
What's the second situation?
The second situation is like in the city of New York, right? They, in 2019, changed rent reform, and all these rent stabilized, rent controlled apartment owners who are buying these apartment buildings for 3 cap rates can't achieve their NOI. You had quite a few years under de Blasio of 0 rent increases. Meanwhile, your insurance is going up 10% a year, and CapEx costs. And so in New York City, those developers, just because of the law and government regulation, saw the value of their assets drop 30-40%. And it's not like the developers did anything wrong. They were just caught between chairs with mayors.
It's funny you said that because I was literally thinking about musical chairs.
And so, in both situations, you could still be a good borrower. You're just having market shifts or government regulation shifts that have negatively impacted you. And they're facing the impossible of how do I refinance and survive another day without having given my assets back to the lender. Now listen, 2019 rent reform put 2 New York City banks out of business, right? So it wasn't just the borrowers, the 2 major banks in New York went belly up. So
I want to remind you of a great phrase that I think of when I hear you speak, and it's by Winston Churchill. He's one of my dead mentors, if you will. And he said when he was going up against Hitler, if you're going through hell, keep going.
Exactly.
And that really rings true in the sight of what you see and the way you discussed the borrower's dilemma. It is not with his or her internal factors of who they are and what they've done wrong or right, although seemingly they are talking to themselves right now about what they did wrong or right. It's really the external factors that are putting pressure on themselves.
Correct.
And they need to know how to traverse that terrain. And you, my friend, are giving them the olive branch, specifically in the sector of multifamily,
Correct.
to game their timing of their inevitable exit. So it's kind of like being in the casino a little bit, although without the gambling component. The longer you stay in there, I guess, I don't know, what would the ending of that sentence be? The longer you stay at the casino when in multifamily real estate, what?
Well, I think unlike gambling, hopefully, given that we have a housing shortage and the new development construction pipeline has been reduced, there should be positive absorption. Rents should go up. Your NOI should go up. And therefore, you should be able to refinance your loan with cheaper and better financing or sell it at a profit down the road. So we're at the trough of the market. You never want to sell at the bottom of the market. You want to hold on and try to get some of this recovery that we anticipate happening over the next couple of years.
So holding on is a concept that you have touched on in our discussion here. And you're trying to relieve that, of course, with financing. Holding on is a concept that my clients understand quite well. We have some very serious and big clients that have to hold on and control their assets, even when they have what's called negative carry, right? Currently, there is negative carry. The disparity between what the value of the property today is worth and what it is tomorrow is actually growing, okay, in certain asset classes. What advice would you have for those people where it is growing? Do you cut the cancer or do you live to fight another day? I wonder what you think.
So you're saying your clients have appreciating assets?
Depreciating assets.
Depreciating assets. So you think the value of their asset is, the market value of their asset is declining, but they have a negative basis.
Correct. So the value of the property is not worth what the value of the debt is today. It's upside down, which leads me into the Worldwide Plaza case, which I want to kind of discuss with you, which is a good segue to discuss. You know, what's your opinion on, you said holding, right? Holding on, traversing. When is the right time to let go if people and actors are like you in the system? You kind of give hope to the system a little bit, in my view. What's your opinion on when someone should let go, when someone should sell? Tell me.
So I think Leo here is referring to the fact that in 2007, by history, Harry Macklow bought Worldwide Plaza for $1.8 billion. And then the GFC hit, and similar to Charles Cohen, he had a Fortress personal guarantee loan that had something like $500 million coming due. And so he was forced to sell the General Motors building and many of his trophies in New York City in order to pay off his Fortress personal guarantee loan. And then came due the bridge loan on many of the EOP Blackstone assets he bought in New York City. And one of those assets in particular was Worldwide Plaza. Worldwide Plaza had $1.8 billion of debt on it. Harry Macklow had only put in $50 million of equity. And so because of my experience in banking, I knew how to work through the various layers of mezzanine debt, and we ended up eventually buying the asset from the most senior lender, Deutsche Bank, for something about $500 million. And one thing I learned during the RTC is during a financial crisis, when there are no commercial banks making new loans, the selling bank will always provide you very attractive seller financing. So we're very fortunate to get great seller financing in the middle of the GFC from Deutsche Bank, who was selling us their loan. It was a very calculated risk. At the time, it had about 1 million square feet vacant. And when we did a large block analysis of New York City, we realized that we were one of the last blocks of space available for lease in Midtown in 2009. And when we got the list of expiring million square foot tenants, we knew it was going to be a tenant probably from Brookfield Place. but that rent roll all had 3 years left. So we knew we had to model no rents for 3 years, which we did. Shortly after we closed in 2009, Nomura walked in and leased the majority of the vacant space. And we then sold the building eventually to New York REIT and SL Green for $1.3 billion.
Wow.
And I always say that today's fully leased office building is tomorrow's workout, because eventually those tenants will leave and it will be vacant. So here we are again. Cravath's 15-year lease in 2009 just expired. The building has become vacant, and now it has, I think, $1.3 billion of debt that's maturing. But the building now is 15 years older, and so all the systems and elevators need to be replaced. It's now arguably a more remote and worse location than 15 years ago, because everyone today wants to be by Grand Central or Penn Station and the transportation hubs. However, there is still now probably a big block lack of space available. So maybe you could fill us in on the new chapter, because one, I knew back then only to deal with buying loans from commercial banks or insurance companies, because they can make decisions and sell loans, where if a loan is in a CMBS trust, those frequently are very hard to break loose, because the special servicer wants to try to work it out for a couple of years. So until income really starts going negative and the special servicer has to start funding some of those deficits, they will keep extending and pretending, as we say. And so it's right now in the legal courts between Gary Barnett, who's one of the savviest New York City land players, battling out with SL Green and RXR, two other 800-pound gorillas in the New York City office scene. And it's actually happening at a valuation that doesn't make sense to me. We bought it for $250 a foot. It's arguably worth less today, and I think the most recent appraisal was even less per square foot.
Correct.
But the senior loan balance is at $920 million, and Gary Barnett bought some of the mezz, so his basis is even higher. So I'd love to get your view on how you think it will go through the legal court and where the situation is.
So what I want to do before I answer your question is connect what we have been discussing to the current status of Worldwide Plaza. We discussed debt. We discussed timing. We discussed pressure on the borrower. We've identified certain risks, external risks. So I wanted to connect Worldwide Plaza to what we were currently or previously discussing, which is risk in the market and how you size it, then timing in the market and how you size that, the borrower, the asset. All of that has to be underwritten. Now, getting in the mind of Worldwide Plaza and applying those concepts, I actually want to spring it back to you, but I will give you my opinion on what's going on in the legal sphere. What's happening in the mind of Gary Barnett? What's happening in my opinion, in Gary Barnett's mind is he has a focus. He's aiming really high and really wide with the Worldwide Plaza building for, I think, several reasons. I think he's going to have, a renaissance with this building. I think he sees it as an investable asset. And I believe that at those numbers and at that height, he is not only making an example of what the future of real estate is going to be valued at, but what he can value that value at in the future. And I don't think it's 5 years away, frankly. I think it's maybe 18 months away or 16 months away, for the very simple reason that Gary is a very savvy investor, and he does have a clog net of a lot of assets he had bought and sold and developed, and he is the land king. So he has a really good idea about what he wants to do with that asset. And I want you to share what you believe he will do. That's number one. Number two, in order for him to traverse that asset's impossibility currently, that there is no longer a cravath, right? That makes the impossibility greater. That the valuation has plummeted from $2 billion to $345 million as of April 2025, and the impossibility keeps getting even greater and wider, right? And number three, the actors, SL Green Realty, and I believe the other RXR have really dropped the ball, I think. I think they could have been more proactive as an institution to find a replacement actor. But maybe that is the market, and the market telling RXR and SL that no matter how big or how 800-pound gorilla you are, you can't really find anything right now because the market is narrowing. So in all, it culminates into a litigation. It culminates into a litigation of the focus of what Gary Barnett has for it and what SL Green and RXR are wrestling with. Both have impossibilities. The first impossibility is, what the fuck am I going to do with this building when I get it? And what the fuck am I going to do to not lose this building and keep going? One deals exactly with time, is what you were discussing. I think it's a timing concern for SL Green and RXR because they're not bad borrowers, right? They're just caught in, I guess, the drop of the, what's that game? What's that game
Jenga?
when you drop the ball? No,
Oh.
When you drop the ball into the
roulette,
right? The ball just dropped on red, not on black, and they're caught with their pants down with Cravath exiting. Now, barring that proactivity that they can have got or went into to replacing Cravath, I think ultimately they did the best they could and they got stuck with it. But Gary's impossibility has just gotten exasperated, and so has SL Green and RXR's, because now they're in a tug of war to this building and this asset. So we know that the asset is extremely, extremely valuable because they're both fighting for it. And the court has said that the process of how Gary Barnett had purchased and assigned these interests on the mezzanine level, I think it's $190 million, and now wants to sell it, ultimately to continue to own the building. She has issues with that, particularly to chill the bidding process. So what the law is actually looking at, it's looking at the fairness of the process, not necessarily the purpose of what that building is only ultimately going to become. Who the hell knows? Maybe it's going to become a condo building or residential. You never know, especially with the market being upside down. So that is the legal backdrop. There's a wrestling of this property between two actors, okay, that are very, very savvy.
for just the mezz.
For just the mezz, but ultimately for the building. Because if you own the mezz, you now own the building. Now, albeit with a senior loan. What the court is saying is, let's look at who is behind the first and the senior, whether Gary Barnett wants to chill the bidding process and ultimately take that building for himself, which would fly against the face of a judicial, I guess, temperament of saying, I can't let this happen, because if I let this happen, that means that the market is working against himself. Why is the market working against itself? Because you cannot have a fair exit or disposition of an asset when the process is rigged. That's why you have laws. That's why you have rules. And that's what the court is currently examining, the commercial reasonableness of the disposition of Gary Barnett's UCC interest in the mezzanine loan of $190 million. And currently, we're about 2 days away from a boatload of questions that Gary Barnett has to answer. And ultimately, we're going to get those answers because the court required it. But I wanted to peel back the onion a little bit with you and get your take about what the purpose is for Gary Barnett and what he wants to do with the property, and why SL and RXR are trying to wrestle their way into that property and keep it. There must be something very, very valuable about that property. I wanted to know what you think their plans are for it and how you would handle the restructuring if you got your hands on it.
Wow, that's a big question. I will start with the fact that the office market is recovering very fast in New York. In fact, the Class A office space, which only a couple of years ago was at an 18% vacancy rate, is probably this year going to dip below 10%.
Okay.
And once you hit 8%, you should start having good rent growth. One. Two, there is tremendous leasing activity happening. People love being in New York. And there are very few large blocks of space left, Class A, that's available. So we're seeing values of New York City office building increase quite a bit. In fact, SL Green bought out one of their partners at 105th a year ago for like $375 million, and they just sold a partial interest to Rock Point at a $500 million valuation. So in 1 year, that's almost a 30% increase in value, mind you, on Park Avenue. But that is just an example of how quickly the office market is recovering. And one doesn't know if Gary Barnett potentially has a very large tenant in his pocket, similar to how we knew that there was going to be a tenant from Brookfield Place probably ready to come to the building when we bought it. So you don't make such a big bet on a 1 million square feet vacancy without knowing who your user is going to be. So whether Gary is thinking of converting the building to luxury condos, because it does have spectacular views, high ceilings, practically column-free office space. So one doesn't know whether he's going to convert it to luxury condo or whether he has a very large office user in his pocket. He must have a highly confident use in his mind for making such a large bet. Secondly, and I think we've discussed this before, it really depends on what's going to go on with the senior loan, because that's where your investment basis is really set. And the void between the $920 million par value of the senior loan and the $350 million appraisal there's a big void there. And, understanding what happens to the senior loan is really much more critical than even the mezz.
So the criticism of, I think, what the judge is probably telling Barnett is, hey, it seems like you're trying to chill the bidding process, but I haven't read the scope of what they would discuss. We actually ordered the minutes. We're going to read them and report back. But what I see is the court being critical of that. And you are correct. You'd have to work out the first in a very real way, because the value is simply not there even if you got the first. It's the $940 million.
Gary must control the first one way or the other. So you're really a distressed debt expert.
Correct.
So if a loan is in a CMBS trust, a SASB, and it's sold, because it's a public security, does it have to be disclosed when the SASB single borrower, single building loan is sold? Does that have to be publicly disclosed?
Absolutely, because it has to be reported.
So
what's probably happening is that Gary has a conditional right to purchase it, which currently doesn't exist.
Embedded in the mezz?
Maybe. And that's what I think.
Does mezz sometimes have... Mezz lenders frequently do have the right, but at par, to cure the senior and assume it, but at par. So
what
that doesn't quite work well.
Well, if you have it at par, you could conceivably get the mezz and plunge it into bankruptcy and begin the restructuring process formally. But I don't want to veer off too much into the weeds of Worldwide Plaza. I think we spoke very well about Worldwide Plaza. I think we've extricated what the impossibility there is. The impossibility there is about purpose, okay? The impossibility there is about dealing with a few 800-pound gorillas. And the impossibility there is about the timing of the market and where Worldwide Plaza is going to go. I want to leave that there and discuss the last thing is how has your upbringing in the distressed space prepared you for what is to come? And what is to come? Please tell us, Rob.
Yes. So, the last 30 years of my career, I've had the benefit of interest rates falling and therefore cap rates falling. And it's been a beautiful ride because, values just kept going up and returns were great in real estate. And I always said, man, when we're at the end of that 30-year stretch, it's going to be painful because now we can't rely on cap rate compression to create real estate returns. We need to rely on NOI growth. And we're in a very challenging NOI growth period because we have a lot of inflation between insurance, CapEx costs, technology. And so I think over the next decade, real estate has a uphill battle because real estate investors have to learn to grow NOI to create returns and can't rely on financial engineering or cap rate compression to generate returns.
I agree with you. And I think I have a concept. It's called going from -1 to 0, where the debt stack that is stacked against you currently in a market where, again, the disparity is growing between what was borrowed and the value of the property, I think we're not going to save every borrower. And I think that there is going to be an exchanging of hands. We see it on the Worldwide Plaza level, and we're going to see it on every other level because the liquidity, would you agree, is constrained and is going to be constrained
Correct.
For the conceivable future?
Correct. Absolutely. And this is not the first time in the last 200 years of America where we're going through this, real estate distress. This has been going on for centuries. And it's just that we had a beautiful 30-year run. However, I do think where in the early 90s, we discussed the RTC and the government would just flash sell loans and things could be resolved more quickly because banks and our financial institutions and system is more mature and sophisticated. There won't be as many juicy distress buys to be had because lenders will work with borrowers more patiently. Instead of just being 3 distressed buyers in 1990, there are now 200 distressed funds. So the market is much more sophisticated. In the 1990s, when we were buying a building, you had to print out a book. You had to call someone to come tour the asset. They would have to fax in an offer letter. Now the brokers email it to 3,000 people globally. The markets are significantly more efficient today than they were 30 years ago. So there won't be as much juicy distress returns to be made. And so you really have to focus on growing NOI and real estate fundamentals to create alpha in the future, and can't rely on just financial engineering.
So I guess the prime ways of now confronting the impossible on a macro level today is sitting on the maturity of the marketplace, you're saying? That's
Correct.
how you're confronting the impossible there.
Right.
And the second way is creating partnerships with individuals such as yourself and organizations that you run to gain from that liquidity in the spat of the timing between those two bridges.
Correct.
Rob, I want to thank you for coming on the Confronting the Impossible today.
Thank you for having me, Leo.
It was a pleasure to have you. I think we had a very insightful conversation. I hope the audience does enjoy the trials and tribulations of the market, specifically the multifamily market and the office market. Till next time, thank you.